Hello again and good evening. Happy Monday to you all. I want to welcome you into the second session of our training. I hope you all have had a good day so far, that your Monday has been good to you. Do we have any questions or concerns about anything that we talked about on Saturday before I jump into a recap?
No, ma'am.
All right. So again, I ask if you are not speaking or not talking, you keep your devices on mute. You are more than welcome to come off mute at any point if you have any question. If I'm going too fast, if I need to slow down, or again, if you just need to ask a question, you are more than welcome to come off mute because I more than likely will not see the chat to be able to answer or to see your question during the midst. So if it will be easier for you to just come off mute and stop me in the midst of what I'm talking through or talking about to answer your question if you would like, or if you would just want to hold it to the end, that's fine as well. All right. So I don't think there's any questions at this point. So I'll hop right into a recap for from Saturday. And so on Saturday, we talked about a lot of different things. One of the things that we talked about was the mission of the VITA TCE program. And the mission of the VITA TCE return preparation program is to assist eligible taxpayers in satisfying their tax responsibilities by providing free tax return preparation to establish the greatest degree of public trust. Volunteers are required to maintain the highest standards of ethical conduct and provide quality service. We also talked about on Saturday how you are protected as a VITA volunteer as long as you are within your due diligence, within your scope of service as a volunteer. We talked about your responsibilities as a VITA TCE program volunteer. We talked about you having the responsibility to provide quality service and to uphold the ethical standards of the program. When you begin as a volunteer, you will be asked to sign the Volunteer Standards of Conduct Agreement, which states that you will adhere to the standards of following all quality site requirements by not accepting payment, asking for donations, or accepting refund payments for federal or state tax return preparation from customers, by not soliciting business from taxpayers. You help or use the information you gained about them for any direct or indirect personal benefit for yourself, any other specific individual or organization. Do not knowingly prepare false returns. Do not engage in criminal, infamous, dishonest, or disgraceful conduct or any other conduct considered to have a negative effect on the VITA TCE program, and treat all taxpayers in a professional, courteous, and respectful manner. As I mentioned on Saturday, sometimes those taxpayers can get upset, can get tired of waiting, and so they can take or want to take you to something other than being professional or courteous, but you want to remain that at all times. As a volunteer, we follow standards for return preparation. That is to become certified, use the intake, interview, and quality review process, use reference materials such as your 4012, the publication 17, to complete the steps to electronically file tax returns and to adhere to the privacy and confidentiality guidelines. We also on Saturday talked about due diligence and what that means as a VITA volunteer. That means doing your part to ensure tax returns are correct. As an IRS certified volunteer, you ensure that the information on the return you are preparing or reviewing is correct and complete. Generally, IRS certified volunteers may rely in good faith on information from a taxpayer without requiring documentation as verification. And we talked a little bit about that during Saturday's session. However, part of due diligence requires volunteers to ask a taxpayer to clarify information that may appear to be inconsistent or incomplete. When reviewing information for its accuracy, volunteers need to ask themselves if the information is unusual or questionable. If at any time a volunteer becomes uncomfortable with the information provided by the taxpayer, the volunteer should not prepare their tax return. And we talked about that as well, that anytime that you are unsure or uncomfortable with the taxpayer or with the information they provide, you don't have to prepare their return. You always have a choice, and that choice is yours to make. No one can make that choice or make that decision for you. You can always decline to do that return. We talked about the volunteer standards of conduct. Um, there are six of those. Number one is to follow all quality site requirements. Number two is to do not accept payment, ask for donations, or accept refund payments for federal or state tax return preparation from customers. Three is to not solicit business from taxpayers. Four is to do not knowingly prepare false returns. Five is to not engage in any type of conduct that can negatively affect the program. And six is to treat all taxpayers in a professional, courteous manner. We also talked about how failure to comply with those standards could result in being removed from the VITA TCE program, being added to the volunteer registry, or barred from any type of VITA TCE activity indefinitely. You can be deactivated from any site, from volunteering at any site. You can be removed from all IRS products. You can also, your action can result in a sponsoring organization losing their partnership with the IRS. And so we want to always make sure that we are acting within the guidelines of the VITA TCE program. On Saturday, we also completed the intake, interview, and quality review training. I made mention that all tax preparers, quality reviewers, instructors, and site coordinators must pass the intake, interview, and quality review test. SPEC has determined that there is a direct correlation between the proper use of the Form 13614C that I showed on Saturday and the preparation of an accurate tax return. The Form 13614C is required to be fully completed for every tax return prepared at a VITA TCE site before tax return preparation begins. Volunteers certified in intake, interview, and quality review may assist taxpayers in completing Form 13614C. That form is considered to be complete when all questions that are applicable to the taxpayer is answered, and all unchecked questions are discussed with the taxpayer and determined not to be applicable to them. Only IRS tax law certified volunteers may answer taxpayers' questions related to tax law on the Form 13614C. We also talked about the quality review process and how it is an effective and thorough process to ensure that that return is completed correctly. You want to always make sure that you are confirming the identity and taxpayer's Social Security or ITIN numbers. We want to make sure that you are engaging the taxpayer and getting their participation in that process. You want to verify all items is listed or done that's in that quality review checklist that's in your publication 4012. You want to verify that all accurately completed Form 13614Cs are used. You want to review all supporting documentation. You want to review all tax law references if needed. And you want to advise the taxpayer of their responsibility for information on the tax return before they sign. Every tax return prepared at a VITA TCE site must have a quality review. This can be completed by using the quality review checklist that's listed in your publication 4012. There are only two acceptable forms of quality review, and that is a designated review and the peer-to-peer review. Self-review is never an acceptable review process. All taxpayers must be informed verbally of their responsibility for the information listed on their tax return before signing their tax return. And sites must not transmit tax returns before a quality review is completed and the taxpayer has signed the Form 8879. We then talked about the certification process and how the certification process works. We talked about Link and Learn. I showed you the landing page, how to sign in to Link and Learn, as well as the practice lab. If you have not already completed an account or created an account for the practice lab or Link and Learn, then you will need to do that in order to complete your certification. Volunteers who do not pass the test the first time must review the course material and try again. All certification tests must be passed with at least an 80%. You have two chances to complete those certifications. After you pass any exam that you complete or certification that you complete, then you will need to sign the Form 13615, which is your volunteer standards of conduct agreement, and provide that to your site coordinator at any site that you are volunteering at. Any questions or concerns about anything that we discussed on Saturday?
LaQuisha, I'm having an issue with getting in my practice lab.
Okay. And we can go through that at some point this evening.
Okay. Okay.
Any other questions or concerns?
Yes, my name is Ted Clark, and I'm having a hard time getting on the Zoom part. I had to call in the Chicago number to get on.
Mm-hmm.
So, I mean,
So is it giving you an error with the Zoom link, or what's the issue?
it is. It is. And
So
it's
are
telling me to put in the code, and I'm putting
mhm.
in the W, and I've even got a coworker to try to help me. It's something, I don't know. So we had to do it like through the Chicago number call in.
Okay, so I mean it's fine that you're calling in. Is the only thing that
Okay.
I'm showing our PowerPoint slides is so it's really nothing important for you to see. United
Okay.
Way has dropped the password in the chat box, and it's you as a United. So it's United Way. Hold on, let me get it for you. So the Zoom password is UWM, S as in Sam, F as in Frank, T as in Tom, P as in Paul. Is that what you were using?
Yes,
Okay.
because it came through an email I got today.
Right. And so if you clicked on that first link, you shouldn't have had to enter the username and password or the meeting ID and password. It should have brought you straight to the meeting.
We'll try it again, but I'm gonna stay on the line with y'all like this until I can get it to come up
Okay.
because I don't want to miss nothing.
Okay. So the only thing that I'll be showing is PowerPoints that I'm using, but that's not something that you necessarily have to see, because I cover the
Okay.
information that's listed on the PowerPoint.
Okay.
All right.
Okay. Yes, ma'am. Thank you.
Mm-hmm. Any other questions or concerns?
No, ma'am.
All right, then we'll jump into the tax law portion of it. Let's see. Are you all able to see my screen?
Yes.
Okay. So the training, for whatever reason, always starts out with the premium tax credit. Not sure why they have it set up that way, but we'll go through the way that they have it set up. Again, if I go too fast or I go too slow, or you need to ask a question, you're more than welcome to come off mute to ask that question, because I may not see the chat. If you are putting it in the chat, I will check the chat at some point before I switch over to the next set of PowerPoints to answer, to see if there's any questions that need to be answered. If you just want to put them in the chat. All right. The Affordable Care Act changed the existing health insurance market by prohibiting insurers from denying coverage or charging higher premium because of an individual's pre-existing condition. that Affordable Care Act created the health insurance marketplace and provided a premium tax credit that eligible taxpayers may be able to claim on their federal income tax return. Let's see. Hold on one second. The objective of this lesson is to determine who is eligible for the premium tax credit, to calculate the premium tax credit, and to report the taxpayer's premium tax credit on the tax return. Now, as I stated on Saturday, there is no calculation that you will need to do for anything that you are doing, including the Affordable Care Act or the premium tax credit. The software does all of that for you once you've entered that information into the system. The forms that you will need, that the taxpayer will need to provide to you in order for them to complete the or get the premium tax credit is the Form 1095A. You don't need to see the taxpayer's insurance card. Form 1095B and Form 1095C are provided to taxpayers from if they have employer coverage. And so those are not any that you need to see. The only thing that you need from a taxpayer, if they advise you that they have insurance through the marketplace, is that Form 1095A. If they advise that they have insurance through the 1095A or had insurance during any point of the tax year, then and they state that they do not have their Form 1095A, you need to send them back to get that form. They can contact the marketplace. Most times, a representative from the marketplace will give them those numbers from that form over the phone, and you can use that. You don't have to have that form in hand in order to complete that 8962, but you want to always follow the direction of the site coordinator. But a lot of times the taxpayer would get on the phone with the marketplace and get the numbers that's needed off that form in order to get their return completed. Taxpayers may choose to have advanced payments of the premium tax credit or the APTC, or get all of the benefit of the PTC when they claim the credit. 1095A taxpayers who purchase health insurance from the marketplace will receive this form. Don't let them tell you I didn't receive it. I shouldn't receive it. Even if they had it for 1 month out of the year, then they are going to receive that Form 1095A, and you will need it on their return, because their return will reject showing that they at some point during the tax year had that insurance through the marketplace. The federal poverty line states an income amount considered poverty level for the year and is adjusted for family size. This is not something that you will need to know, but if you want to know what that information is, it is listed in your publication 4012. This is something that is used to determine what a taxpayer can or cannot pay, or what that amount that they are paying for that insurance should be. In order for the taxpayer to claim the premium tax credit, they claim it on the Form 8962. That form is automatically populated once you've completed the form or input the information from the Form 1095A. That form must be filed with the tax return if the APTC was paid on the taxpayer's behalf, or if the APTC was not paid but the taxpayer wishes to take the PTC. You should complete the Form 8962 only for health insurance coverage in a qualified health plan purchased through a marketplace. This includes a qualified health plan purchased on healthcare.gov or through a state marketplace. The taxpayer will know if they have insurance through the marketplace. They won't have to guess, and you won't have to guess. If they are unsure, if they don't remember that they had insurance through the marketplace, it's going to tell you once their return rejects. And so then at that point, they'll need to bring in whatever documentation that is needed in order to get their return corrected, or they'll have to mail their return in. If the taxpayer is sharing a policy, meaning that they were married and they got divorced, or they have a policy with a dependent and they share their policy, then that's outside the scope of VITA. Different parts of the Form 4 of the 8962, parts 4 and 5, have to be completed, and VITA does not do that. And so if they come in and they tell you that they had a shared policy, with the marketplace, then you'll need to refer them to a paid preparer because the VITA program does not do that. The Form 8962 premium tax credit is used to calculate the credit and reconcile the advance payment of the credit. And so what that does is at the time that the taxpayer gets the insurance through the marketplace, their circumstances could have been they were unemployed, they did not have the funds or the capability to get insurance anywhere else. And so they got the insurance through the marketplace. But at the time that they are filing the return, their circumstances could have changed. And so because of that, they have to reconcile whether or not they paid too much into the insurance or they did not pay enough. And so that determines whether or not they will receive the premium tax credit or if they owe or if there's a penalty for them not paying enough into the insurance based on their circumstances. Changes in circumstances, just like I just stated, can affect the amount of the actual premium tax credit. That includes increases or decreases in household income, marriage, divorce, birth or adoption of a child, or any other changes in the that make up the household composition. Gaining or losing eligibility for government-sponsored or employer-sponsored health care, or a change in address. Any questions or concerns as it relates to the Affordable Care Act? All right. So in summary, the Affordable Care Act addresses health insurance coverage and financial assistance options for individuals and families, including the premium tax credit or the PTC. Only taxpayers who purchase qualified health care coverage through the marketplace for themselves or a family member are allowed a PTC. The PTC is calculated and the APTC is reconciled on Form 8962. Taxpayers will receive Form 1095A from the marketplace, which will contain information necessary to complete the Form 8962. The PTC is claimed on Form 1040, Schedule 3. Any excess APTC that must be repaid is entered on Form 1040, Schedule 2. So we'll go right into filing basics. This lesson will help you to determine who must file a return or who should file a return. It states to verify the taxpayer's identity. Most times this does not cover verifying the taxpayer's identity, but that is something that we did cover on Saturday on how to verify the taxpayer's identity and what information or resources is needed in order to do that. So the question asks who must file. So the Form 13614C again is very important to determine who must file. The taxpayer looking at that form, when they get to the income section of that 13614C, that's going to determine whether or not that taxpayer may or may not have a filing requirement. There are also charts in your publication 4012 that you can use to determine or to help the taxpayer determine whether or not they have a filing requirement. There are also interactive tax assistants that are available to help you. You would ask those questions to the taxpayer to help them determine whether or not they have a requirement of filing a return. A lot of times, even if a taxpayer does not have a filing requirement, they will still file a return. The most requested reason for that is if they have worked a job or if they have made some sort of received any type of payment that federal withholdings was taken out of. They will have to file a return in order to get those withholdings back. That's the only way they are able to get those withholdings back is by filing a return. So on the screen, you see a capture of chart D. That is one of the charts that is in your publication 4012 that will give you information on who should file. And so if there's a question on whether or not the taxpayer should file, you can always refer to your publication 4012 in that chart to help answer that question for you. As you can see, number one, shows that you had income tax withheld from your pay, your pension, Social Security, or other income. So they will file their return in order to get that money back. It states that out of scope is the health coverage tax credit. It states verifying the taxpayer identity, what are acceptable identity documents to verify identity. And we did go over that on Saturday, and we know that any type of picture ID will verify the identity of the taxpayer spouses, they are married filing joint. What are acceptable TINs, and that's taxpayer identification numbers, or more commonly known as Social Security numbers. And we talked about Social Security cards, a statement from the Social Security Administration, or a prior year return. Again, you want to always refer to your site coordinator to see what their process is in verifying the identity of the taxpayer. We want to always ensure that names and identification numbers are entered accurately, because if they are not entered accurately, those will cause returns to reject. The names must match the names on the Social Security card. That's why it's so important for taxpayers to have the Social Security card or a statement from the Social Security Administration or the prior year return to show how that name was listed on their prior return. Because if there is any doubt, if there's any mistakes, those returns can be rejected. Verifying the taxpayer information also protects them against identity theft. You want to remind taxpayers that correct information is necessary for them to receive any type of age-related tax benefits. If a taxpayer cannot verify and you cannot substantiate their identity, then that is out of scope for the VITA TCE program. You cannot help them. We have many processes in place for identity verification. If they can't pass any of those, then you can't help them. You need to send them to a paid preparer, or they need to find someone else to complete their return. But the VITA program won't be able to assist them if they can't verify their identity. And this slide talks about choosing the appropriate schedules. That's not something that you would have to do. The software will automatically choose the appropriate schedules based on the information that you are entering on that in that software. And so based on what information you enter, it's going to automatically populate that information where it needs to go. So you never have to figure out if the correct schedule was added, or where this needs to go on that line. As long as you are entering the information where it needs to go, it will automatically populate to the correct schedule or form. If there's any question or doubt of where that information needs to go, you can always refer to your publication 4012, because there is a chart on in that publication that will show you or tell you what information needs to be entered.
Lucretia,
Yes, ma'am.
for the 1040 SR, will it automatically populate a 1040 SR, or do we have to specifically choose that form if they're 65 and over?
The software will most times automatically populate. And so that form is, although it's for 65 and older, it's still based on sometimes it's based on the type of income they have. But if it's like a simple return, the taxpayer only has Social Security income, it shows they're 65 or older, then it will populate that form. And so no, so that's you don't have to pick the form. The software automatically picks those forms for you.
Okay, thank you.
Some potential pitfalls to look out for is Canadian numbers. They are very similar to Social Security numbers. I've personally myself never seen a Canadian ID number, or had someone with a Canadian ID number, or had a return reject for a number not being a Social Security number. And it tells you to be on the lookout for any type of indications of fraudulent activity. If there's a Form W-2 that is typed or handwritten, or one that has noticeable alterations. If there's a Form W-2 from a company that looks different from other Form W-2s issued by the same company, and you will get that a lot, you will see repeat W-2s to the point to where you will start memorizing the EIN number. Because so you'll see them so often that you'll automatically just remember what that EIN number is for that company. And so it won't be hard for you to know if that W-2 is fraudulent or has been altered if it's from a familiar company that you've been seeing over and over again. It says to be on the lookout for a suspicious person accompanying the taxpayer. A lot of times, depending on where the site is, there may or may not be security there. So you want to always be vigilant of your surroundings, and that's anywhere, whether you're at a VITA site or not. Multiple refunds directed to the same address or PO box. Employment or earnings that are a basis for refundable credits, which are not well documented. And similar returns, meaning the same amount of refunds, same number of dependents. And that's not always fraudulent. You will get some returns that look similar. But if there is anything fraudulent or suspicious going on, once you've gotten into the habit of completing returns after you've seen so many returns or input so many returns, quality reviewed so many returns, if something looks off to you, you'll know it. Out of scope is taxpayers who may qualify for the health coverage tax credit or credit for the repayment of previously taxed income, and of course, taxpayers who cannot substantiate their identity. Again, we talked about the charts that are available in your publication 4012 to assist you in who must file and who should file a return. Individuals who are not required to file should file to claim a refund of withheld taxes or credit, or if they're required to file a state return, for any number of reasons can require someone to file a return, even if they are not required to file a federal tax return. And of course, we want to always ensure that we are verifying the taxpayer identity. Any questions or concerns about filing basics? All right. The next lesson talks about filing status. And so our main objective, our main goal is to always choose the filing status that is going to give the taxpayer the biggest advantage. And sometimes the taxpayer will come in and they don't know what is the best filing status for them. 95% of the time, the taxpayer is going to come in and they already know what their filing status is, and you won't have to question them and they won't have to question you because they already know what their filing status is. There are 5 filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse. And so this lesson will give you a really quick overview of how to determine the filing status, but I promise it's not hard. There are things or resources that you can use to determine what that filing status is if there are questions. In order for a taxpayer to file single, they have to be on the last day of the year not married or legally separated or divorced, or they had to be widowed before the first day of the tax year and not remarried within the year. They may qualify for more beneficial tax status. There is a decision tree that's located in your publication 4012. Again, these will be questions that you will need to ask the taxpayer in order to determine what their filing status should be. These are not questions that you can just answer on your own to determine what their filing status should be. These are questions that you will need to ask the taxpayer, and you will need to follow that decision tree to determine what their filing status is. There's also an interactive tax assistant built into the software. And so that you can click that and it'll take you through those same questions. and at the end give you an answer of what the most beneficial filing status should be for that taxpayer. Married filing joint is the most beneficial return for married couples. It's one return that covers both spouses. In order for them to file married filing joint, they had to be on the last day of the year, married and living together. If they are married but lived apart, but they are not legally separated or divorced, then they are still considered married and should be filing married filing joint. If they live together in a recognized common law marriage, and if someone comes in and advises you that they are in a common law marriage, you will need to know what state they are in order for that to be recognized. There, all states don't recognize common law marriage. Tennessee and Mississippi does not, and so you need to find out what state they are saying they were in order for that to be that common law marriage to be recognized. On the last day of the year, if they did not remarry after their spouse died during the year, then they can use the qualifying surviving spouse. Again, it refers you to the publication 4012, filing status tab, filing status decision tree. Married filing separate. Each spouse files an individual return claiming their own income and exemptions. Taxes are generally higher for this status, and some credits are unavailable, while some others are reduced. If the taxpayers are married and you have a lot of taxpayers that will come in together. Husband and wife will come in together and determine that they still want to file married filing separate. And so you can talk through during that interview process, the screening process, determine what their reasonings are for wanting to file married filing separate. Some have been doing it so long, there is no change in their minds. They already know they are married filing separately. Some are new and confused about what the process looks like. And so you'll need to talk to them through what the most beneficial filing status is for them if they don't know. Some taxpayers file separately to avoid potential refund offset due to a spouse's outstanding debt. And so that's the point. If you know about inter-spouse allocation, that you can advise them of the 8379, and that is something that you can add to the return through the TaxSlayer software so that they can still file married filing joint, and the refunds can be split accordingly for the spouses. And so that keeps them from losing out on any credits or benefits of married filing joint, adding the Form 8379 to their return. It refers you to the publication 17 for more information on the Form 8379 inter-spouse allocation and the list of special rules that may apply. Head of household is one of the most common filing statuses that you will see. It states that analysis of the living situation is critical. Most times you're going to have taxpayers that come in and tell you that they are filing head of household. There's no need for you to question that. You don't have to become an investigator or detective to figure out if they are right or if they are eligible to claim this head of household. If they meet the requirements, head of household requires that the taxpayer have a qualifying person. So if they have a qualifying person and they tell you that they are filing head of household, then there is no reason for you to go all into deep research trying to figure out if they are correct. The qualifying person can be a child, a parent, or other relative. It refers you to your publication 4012 filing status tab of who is a qualifying person if the taxpayer has a question on whether or not the person that they are wanting to claim qualifies them for head of household status. Considered unmarried for head of household. Some taxpayers may be considered unmarried for filing head of household if they file a return separate from their spouse, paid more than 50% of cost of keeping up their home, lived apart from their spouse during the entire last 6 months of the tax year, and provided the main home for more than half the year of a qualifying child, stepchild, or authorized foster child. So then that would consider that taxpayer unmarried in order for them to file head of household versus them having to file married filing separately. It refers you to the interactive tax assistant. If there's questions on whether or not a taxpayer should file single or head of household, or again, if there's any question on what that filing status should be, then it refers you to that interactive tax assistant. Qualifying survivor spouse. This filing status is as beneficial as married filing joint. It's available for 2 years and only 2 years following the year of the spouse's death. And so that taxpayer will have to give you that year in which that spouse died. And as long as that spouse has not remarried within those 2 years, that taxpayer can claim the qualifying surviving spouse, but they have to have a qualifying dependent. And so, if a taxpayer's spouse died in 2023, they were able to still claim married filing joint. 2024 and 2025, they are able to claim qualifying surviving spouse if they have a qualifying dependent. One of the things it does not state for married filing separate is that if the taxpayers are filing married filing separate, if one spouse itemizes, the other spouse also has to itemize, even if they do not have enough to itemize. One cannot. If it's John and Mary decide that they want to file married filing joint, and John wants to itemize, Mary only has about $800 that she's able to itemize. She still is required to itemize because John itemized. And so we always want to make that clear to taxpayers that are married filing separate. If one itemizes, the other is required to itemize as well. And so it's always, you have to make them aware of what the rules and requirements are for these filing statuses. The filing status selection can impact the amount of tax credits and deductions, and choosing the correct filing status will or may result in the lowest tax. So we want to always choose the filing status that's going to give the better advantage.
We can't hear you, LaQuisha.
Okay, I don't know what happened.
I hear you just
I hear you.
I hear you just
I hear
fine.
you fine.
Me too.
So if anyone is having issues with hearing, you may want to go out and come back in and see if that works. Any questions as it relates to filing statuses?
Yes, I have a question.
Okay.
So you said something about the qualifying surviving spouse
Mhm.
about 2 years after death. Did you also add that they have to have a qualifying dependent
Yes.
in order to qualify as a surviving spouse?
Yes. So, and if for the qualifying surviving spouse, they have to have a dependent. So, I mean, which is crazy, but yeah. So but they have to have a dependent in order to file qualifying surviving spouse. So if it's John and Mary died during last year, and John, their children are grown, there's no one else they claim on their return, then he would not be able to file qualifying surviving spouse, even though he is one. he wouldn't be able to use that filing status because he does not have a qualifying dependent to claim on the return. He would at that point be filing single.
Okay, and one more thing. You
Mhm.
said for both spouses to itemize if one has to, that is that married filing separate or married filing joint?
That's married filing separate. So anytime taxpayers are married filing separate, if one decides that they want to itemize, then it automatically puts the requirement on the second spouse. Any other questions or concerns regarding filing status? Okay. Out of scope for this lesson is any spouse who may be relieved of joint liability, which is innocent spouse. That's not a form that you can add to the return. While you can add the form 8379 for an injured spouse, we can't do innocent spouse. And so if a taxpayer wants to come in or a couple wants to come in and file their return and do an innocent spouse claim, that's not something that we can do with the return. You can advise them that you can file the return and they can do the innocent spouse claim on their own afterwards, but that's not something that we can do during the processing of the return. It says, depending on your tax assistance program, community property tax laws for married filing separate taxpayers and taxpayers who are not certain they are in a common law marriage. And so you want to always check the state. I have not had, in the years I've done VITA, I have not had one person come in and say that they are common law married. But if you have that instant, then you will need to verify what state they were common law married in. And so, because Tennessee and Mississippi does not recognize common law marriage, so they would not be able to file married filing joint if that's what they're trying to do under common law marriage laws, unless they came from a state where common law marriage is recognized. And so even still, if that is the issue, if that is what happened, then that's still out of scope for the VITA TCE program, and you will need to refer them to a paid preparer. The next two lessons talks about talks about exemptions. The first is personal exemptions. And at the end of this lesson, hopefully you'll be able to distinguish between personal and dependency exemptions and determine if a taxpayer can claim a personal exemption. So an exemption is a dollar amount that can be deducted from an individual's total income, thereby reducing the taxable income. And so many of you may or may not know that deductions for personal exemptions were suspended for tax years 2018 through 2025 by the Tax Cuts and Job Act. Although the exemption amount is zero, the ability to claim an exemption may make taxpayers eligible for other benefits. And so you still encourage taxpayers that if they have qualifying dependents or to claim on the return to still claim them. So while they don't get the dollar amount for exemptions, it may qualify them for other credits. And so personal exemptions are claimed for yourself or spouse if it is a married filing joint. Dependency exemptions are claimed for qualifying dependents, and there are rules on who is a qualifying dependent. You want to always review the form 13614C. Can anyone claim the taxpayer or spouse as a dependent on their tax return? That question is asked on the 13614C. It refers you to the publication 4012. There's a dependents tab, and there is one that says there's overview of the rules for claiming a dependent. There's one for test to be a qualifying child and test to be a qualifying relative. And so even if it's not the child of the dependent, it could be the relative. The taxpayer has been taking care of the mom lives with them. And so that depending on what those rules are, or those tests, then that person may qualify to be the qualifying relative, and that person can claim them on their return. The check boxes on the form 1040 labeled someone can claim you as a dependent and someone can claim your spouse as a dependent. These questions, when you go into TaxSlayer and you're entering the entity information for the taxpayer and or spouse if it applies, this is one of the questions that you can check if it says someone can claim me as a dependent, or someone can claim my spouse as a dependent. And so you're going to check that to mark that someone can, in order for that exemption to be taken off that return that you are preparing. Once you've answered that question, then TaxSlayer automatically fills in the entries as necessary. Taxpayers can claim a personal exemption for themselves if they may not be claimed as another taxpayer's dependent, or their spouse if they are filing jointly and the spouse may not be another taxpayer's dependent. Dependents is another exemption that can be claimed. And so this lesson talks about or helps to determine if a taxpayer may claim a dependent by applying the appropriate dependency test. Again, in your publication 4012, there are tables that you can use to determine both the qualifying child and qualifying relative dependent. And so if the taxpayer is not sure, you can go through those questions with the taxpayer to determine whether or not they can claim that relative or that dependent on their return. Again, we know that the deduction for personal and dependency exemptions has been suspended. However, claiming these people on your return can get other credits or benefits for the taxpayer. A qualifying child or a qualifying relative can be claimed as a dependent. There are 3 tests that must be applied to both the qualifying child and a qualifying relative if the taxpayer is unsure on whether or not that person or persons qualify for to be the qualifying child or the qualifying relative. And that is the dependent taxpayer, the joint return, or citizen or residence test. For a qualifying child, there are 5 additional tests. That's relationship, age, residency, support, and qualifying child of more than one person. Again, it refers you to table 1 in your publication 4012 if there are questions on whether or not that person qualifies as a qualifying child. For a qualifying relative is 4 tests. And so 4 tests for a qualifying relative, in addition to the 2 dependent taxpayer, joint return, and citizen or residence. There must not be a qualifying child. There must be a member of household or relationship. There's a gross income test and support test. And so all of those have to be completed in order for the qualifying relative to be claimed on that taxpayer's return. There is a worksheet for determining support. If the person that the taxpayer is trying to claim as a qualifying relative has income, that worksheet is used to determine whether or not that income will knock them out of being a qualifying relative. And so if that worksheet needs to be completed, it is available in your publication 4012, or you can get that from the software. I'm sorry, irs.gov. Children of divorced or separated parents. There are special rules that apply for children of divorced or separated parents. There is a difference between custodial and non-custodial parents. It refers you to the table in publication 4012. The form 8332 gives permission, the custodial parents can give permission to the non-custodial parent in order for them to release the claim for that other parent to claim they're dependent on their return, or if they've previously given them permission, they can also use that form to release, to revoke that release. And so this is not something that is common in the VITA TCE site. But if the return is rejected for whatever reason and is saying that this form is required, then that form will need to be completed in order for that return completed and attached to that return before that return can be processed or accepted. Taxpayers can't claim a dependent if the taxpayer may be claimed as a dependent on another taxpayer's return. A person who files a joint return can't be claimed as a dependent unless the joint return is filed only to claim a refund of withheld income tax on or estimated tax paid. And in that case, that person will need to note or check that box that says, I can be claimed on another return. And they're only so that they know that, or they need to advise you that they're only filing a return to claim withheld income tax. A person cannot be claimed as a dependent unless that person is a U.S. citizen, a U.S. resident alien, U.S. national, or a resident of Canada or Mexico for some part of the year. There is an exception for certain adopted children. Dependent must either be a taxpayer's qualifying child or qualifying relative. Any questions or concerns about anything we've covered so far? All right. Income from 1040, wages and interest. You should be able to compute the taxable and non-taxable income and distinguish between earned and unearned income and report income correctly on the Form 1040. The good thing about the software that you're using is you don't have to determine what's taxable and non-taxable. You don't have to do calculations. You don't have to figure out what form needs to go where. The software does all of that for you. If the taxpayer comes in and they have some sort of income and they're not sure whether or not that income is taxable, there is a chart in your publication 4012, income quick reference guide. Table A gives you example of taxable income and table B gives you example of non-taxable. And so if they are just unsure of whether or not they should file a return because they have this type of income, you can reference that table to see if that income is considered taxable or non-taxable. Non-taxable are things such as gifts and inheritance and exempt income. Earned income is any income received for work, such as wages or business income. Unearned income is interest income from investments. Again, if there's any type of questions as it relates to what's taxable and what's non-taxable, always refer to your publication 4012 under that income tab. I'm not sure if you can really see the screenshot that's on this slide, but this is what TaxSlayer looks like when it comes to the income portion. And so when the taxpayer gives you those income documents, if they have a Form W-2, then you're going to go to the Forms W-2 tab. If they have a 1099-G or a 1099-R, there's a 1099 miscellaneous or NEC, 1099-K, that income is there. And all you have to do is to hit begin, and it'll walk you through how to enter those forms into TaxSlayer. Once you enter those forms into TaxSlayer, then it's going to populate where it needs to populate. If it needs to generate a different form or schedule based on the income that you're entering, it's going to automatically do that for you. it says to remember to probe taxpayers to determine all sources of income. This is why the 13614C is so important, um, to ensure that taxpayers have provided all of their income and provided all of the income documents that's needed to get their return completed and completed accurately. You can only go off of what the taxpayer has told you. You don't know how many jobs they've had. You don't know if they took from their retirement, if they received or have gambling income, if they received a state refund. You don't know any of that. You can only go off of what the taxpayer tells you. And so if you've probed the taxpayer and they've answered your questions, then if it was something that was missed because they didn't tell you, then that's on the taxpayer and not you, because how would you know? And so those probing questions in during the interview process is important to determine that all information has been received and the taxpayer has all the documents that they need. The Form W-2 is issued to employees by January 31st, or it should be issued to employees by January 31st. And that form is used to report wages and other types of compensation. When you are entering the W-2 into the taxpayer software, you want to ensure that you are looking that form over completely, because sometimes those boxes will have amounts in them that are smaller than the information in box 1 through 5 or 1 through 6. And so when you get to 12 may have 12A, B, C, D. 14 may have something, 13 may have a checkbox. And so you just want to ensure that you are looking over that complete form to ensure that you are picking up everything that's listed on that return, listed on that W-2. When we get into the certification on Wednesday, you'll have an opportunity to play around with entering or completing a return, a practice return, and that will include entering income documents. And so you'll get a feel of looking at the 13614C, because the scenarios or the form 6744 has all of that information in there for you in order for you to be able to complete their return accurately and completely. And so in order for you to answer the questions on your certification. And so you'll get a feel of what that looks like with you entering that information in the practice lab. It says, remember, household employees earning less than $2,200 may not receive a Form W-2, but the income must be reported. Self-employed taxpayers who receive tips should include their tips and gross receipts on Schedule C. If the taxpayer has earned any type of income, they're going to tell you. A lot of the taxpayers are repeat customers or taxpayers, and they've been doing it for several years, so they know what information you need in order to get their return completed quickly and completed accurately. And so they're going to have all that information laid out for you, so that there's no questions on what needs to be entered on their return. And so most times you won't even have to question them because they come prepared because they've done it so many times before. Scholarship and fellowship income. Taxable scholarship income may be reported on Form W-2 and Form 1098-T. If the taxpayer did not receive a Form W-2, the taxable amount should still be reported. There's, again, it refers you to the publication 4012, the Education Benefits tab, tax treatment of scholarship and fellowship payments. Again, this is not something that is common or something that you will see a lot of, because a lot of times when taxpayers or their dependents are in school and they receive any type of scholarship or anything to that nature, that scholarship, the language in that scholarship advises them that it needs to be used for tuition or for their learning. And so that's what it's used for. And so that makes it, a lot of times they're not going to use that as taxable income. And so that's not something that I've seen, and it's not something that's common, although you could see it.
I have a quick question.
Mm-hmm.
It's not directly pertaining to what you just said, but it is in the education category. So what if we have a student who, got a scholarship or whatever, or financial aid, whatever they do, and someone carries them, but they had a job and they still filed their W-2 themselves. Would their education form go on the person who files them or on their own with the W-2?
So a lot of times you have college age children, especially those that are under 24,
Uh-huh.
that the parents are still claiming. And so if the
Right.
parents are still claiming, then that 1098T is going with the parent.
Okay.
And
Okay.
so if the parents are not claiming them, and that student is filing the return themselves, then it's going to go with them. And so
Oh,
it just depends on who is claiming that dependent, on who's using that form.
got it. Thank you.
Mhm. Any other questions? And we'll talk more about education credit when we get to credits. Income is something that's common that you will see. Interest income is considered unearned income, and it is reported on the Form 1099 INT. Um, the common sources for a taxpayer receiving a 1099 INT comes from savings accounts, CDs, savings certificates, things of that nature. If the interest is not at a certain threshold, then that organization may not send a Form 1099 INT. But a lot of taxpayers will go online or to whatever that servicing agency is and get that amount. And so they would just tell you what that amount is, and you can just add that amount in. You don't have to have the 1099 INT in order for you to include that interest income on their return.
Look, if that income,
Mhm.
if that interest income is under the threshold of where they have to report it, even if you enter it, will it still be calculated?
Yes. And so if the taxpayer comes in and says, I have three 1099 INTs, but I also had $20 of interest from another bank, but they didn't send me one because it was only $20, but I want to include it. And so that's fine, because the only thing that the software is asking you for is the name of the payer, the amount. And so it's relatively easy for you to just enter that interest amount that they're telling you about. So if they've told you, then it needs to be entered. And so if they come in and say, well, I only have three statements, although I had four accounts, but the fourth one was so low they wouldn't send me a document, but I know how much it was, and so you can still enter that on their return.
Why would they want it entered?
Because it was interest that was earned. And so you have a lot of taxpayers who they're so used to doing everything. So because I receive a 1099 INT, that I know interest should be included on my return. And so even if I don't receive a document, I still want that amount entered. And so you have a lot of taxpayers who go online religiously and look at their bank account or whatever it is for the year, or they look for a 1099 INT. There isn't one, but I can see my year end statement that shows that I got $19 of interest for the year. And so they want to include it. And so it's their preference uh, to include it.
Okay.
Dividends are reported to the taxpayer on the Form 1099 DIV. This is not something common, or at least common for me. I may have done probably one a tax season. But there are ordinary dividends, Section 199A dividends, qualified dividends that are eligible for a lower tax rate. Again, it refers you to the publication 4012 income tab if you have any questions regarding dividend income, or to the publication 17. One of our scenarios for the certification includes dividends, and so it'll give you an understanding of how to enter that information into the software. Generally, all dividend income is reported on Form 1040 lines 3A and 3B for qualified dividends and ordinary dividends. The capital gains distributions will appear on Form 1040. If the taxpayers advise that they had dividends, then they will have the documentation they need in order to claim that on the return. So you want to ensure that the taxpayer, if it's notated on the Form 13614C, then they should have their annual brokerage statement. If they did not receive a Form 1099 DIV for the dividend that they are referring to. The Schedule B is needed if the taxpayer's ordinary dividends are greater than 1,500, and it's going to automatically populate that Schedule B if you are entering information as it relates to dividends. If the Form 1099 DIV box is labeled unrecapped Section 1250 gain, the Section 1202 gain, cash liquidation distributions, and non-cash liquidation distributions are checked or have anything entered in those, then they are out of scope for the VITA TCE program. State and local refunds. Taxpayers will receive a Form 1099-G if they received a state or local refund. It only needs to be reported if the taxpayer itemized deductions in the previous year and they received an income tax benefit, and they do not report if state sales taxes were deducted. A lot of times the 1099-G is not used. A lot of times the taxpayers don't bring it, or if they do bring it, you can enter it into the software, and the software will pick up if is included or not based on the information that you entered. It's going to ask you, did the taxpayer itemize last year, and or whatever questions to see if that refund should be included in their income. And so a lot of times the taxpayer did not itemize or did not receive the income tax benefit, and so the 1099-G does not have to be reported. The taxable portion of the refund is reported on Form 1040 Schedule 1 if the taxpayer meets those requirements. And it tells you to click the income from the federal section, and we'll go through all of that once we get into the practice lab. Alimony is, again, not something that is common, not something that I've seen during my time in VITA, but it advises you to do not confuse child support payments with alimony. And if the taxpayer comes in and states that they are paying or receiving alimony, then it's going to that's going to be important because it determines how it is reported or reflected. And so you will need to ask the taxpayer if they have a post 1984 and pre 2019 divorce or a post 2018 divorce. Alimony is reported on the Form 1040 Schedule 1 if they are receiving alimony, and is reported on Schedule 1 adjustments to income section if they are paying. It states for any divorce or separation instrument executed after December 31st, 2018, or modified after that date, alimony and separate maintenance payments are not deductible by the payer's spouse and are not included in income by the recipient of the payments. Again, alimony is not something I've ever seen, and it's not common in the VITA TCE sites. The 13614C does ask about alimony on the income page, and so it will ask what the amount is and if it needs to be excluded from income, because if someone is paying alimony, they already know what the rules are. And so they'll be able to answer whether or not it needs to be excluded from income, or, and that's if they're paying, if they are receiving alimony payments. They have to have the spouse's SSN, and if there needs to be an adjustment to income. Any questions or concerns about income from 1040, wages and interest? Out of scope is taxpayers with income from other gains or losses or farm income. If a taxpayer uses the accrual method for reporting income, taxpayers who buy or sell non-covered bonds between interest payment dates. If a taxpayers have a Form 1099 INT with entry in specified private activity bond interest box checked. If adjustments are needed for any of the amounts listed on the Form 1099 OID, or if the taxpayer should have received Form 1099 OID but did not receive one. If on the Form 1099 DIV, the boxes labeled unrecapped Section 1250 gain, Section 1202 gain, cash liquidation distributions, and non-cash liquid distributions are checked or have an amount that's out of scope. State or local income tax refunds received in the current tax year for a year other than the previous tax year is out of scope. If the taxpayers have an alimony or divorce agree that was executed before 1985, and a minister whose tax return has a parsonage or housing allowance. Those are out of scope for the VITA TCE program. Any questions or concerns about anything that we have covered so far? All right. Let's do a 10-minute break. Be back at 7:40 before we hop into the next set of PowerPoints. Back in with business income. Business income is one of another common type of income that you may or may not see, depending on what site you are at and the taxpayers that you are servicing. But the VITA TCE program does prepare Schedule Cs depending on what business expenses the taxpayer has. And so the objective of this lesson is for you to determine how to report business income, determine what business expenses are within scope, know how to complete a Schedule C, identify any red flags when preparing a Schedule C tax return with EIC. This is not something that I think I've seen a Schedule C with EIC. So that one may not be as common. And telling taxpayers which records to maintain. So anytime a taxpayer comes in and they have business income or loss, you want to always ensure that you are asking probing questions to determine if that taxpayer or spouse had a business income or self-employed. Sometimes what a taxpayer is doing is not considered a business, but a hobby. And so if they're not sure, you can always refer them to irs.gov or to the publication 17 in order to determine whether or not what they are doing is considered a business. Business income commonly comes from, or the information is normally found on a Form 1099 NEC, which is non-employee compensation. The 1099 NEC has replaced a lot of the 1099 miscellaneous forms. However, you still may see a 1099 miscellaneous. The Form W-2 if that taxpayer is a statutory employee. The Form 1099-K, you will see these a lot from payment card and third-party transactions such as Uber or Lyft or any type of services like that. A taxpayer will receive a Form 1099-K depending on the amount they made. They may not receive that 1099-K or 1099 NEC And so a lot of them will still tell you the amount that they made. Taxpayers' books and records is another source of that business income information. You will have some taxpayers that are detailed in their information, and they'll have a ledger or a log to show you their receipts, or they'll have the information available and just have the totals for you. And that's fine as well for you to enter that information where the 1099 NEC or miscellaneous would have went. Cash payments to self-employed taxpayers must be included as business income, even if it's not reported on the Form 1099 NEC. And so you could have a taxpayer that has a 1099 NEC as a contractor or whatever their job is, and then they advise you that I had $600, $1,800, 25, whatever that looks like in cash. And so there's a spot in the software for you to enter that amount of income that the taxpayer is telling you that they received. Qualified Medicaid waiver payments are treated as difficulty of care payments and are excludable from gross income. If you can see the screenshot that's on the screen, this is what the Schedule C in TaxSlayer looks like. It says that if a taxpayer had cost of goods sold or depreciation or expense for business use of home, then that is out of scope for the VITA TCE program. Schedule C shows income and expenses and the resulting net profit, if any. It also shows a business profit or loss that is reported on the Form 1040. What are the conditions for a Schedule C being in scope? The taxpayer must have less than $50,000 in business expenses. They must use the cash method of accounting. And so if they tell you they use any other type of method for their accounting, then that's out of scope for VITA. They have no inventory at any time during the year. They did not have a net loss from the business. They have no employees during the year or paid contract labor for services. They are not required to file a Form 4562. They did not or do not deduct expenses for the business use of a home or do not have prior year unallowed passive activity losses from this business. If the person that's doing the interview with that taxpayer should go through all of this with the taxpayer if they are advising that they normally file a Schedule C, or they have a 1099 NEC or 1099K, and they are using that to file a Schedule C. And so that screener should be going through this type of information with that taxpayer, so they should not get to you and then you find out that they are out of scope because they don't use a cash method or they have inventory or it's going to result in a net loss for that year. And so that interview process, which is why that interview process is important, is an important step in getting the taxpayer where they need to be in a timely and accurate manner. In order to clarify the taxpayer's business income and expenses, you want to ensure that you are asking the sufficient questions of the taxpayer in order for you to be satisfied that the taxpayer actually conducts a business. Again, some people will start a business as a hobby or out of a hobby. And so the publication 17 goes more into detail as it relates to whether or not this is considered a business or it is considered a hobby. And if it's considered a hobby, then a Schedule C is not necessary. But if the taxpayer is actually conducting and running a business, then a Schedule C is. If the taxpayer has records to support income and expenses and can reasonably reconstruct the income and expenses records. Now, while you won't need detailed income and expenses record, if the taxpayer has that log or has the totals of what they made for the year and what their expenses are, then you can take that, but you need to make them aware that they need to reconstruct those income and expenses records and have those in case of there is any type of audit or the IRS comes back and questions what that income looks like or what the expenses are. You want to also ensure that all income and related expenses have been included on the taxpayer's Schedule C. The taxpayers must be prepared to provide receipts and other documentation to support their claim in the event of an IRS audit. And so you want to always ensure that while you don't need all of that documentation, all that paper, you let the taxpayer know that they still need to keep it in case the IRS decides that they want to audit that business or that return. There are certain situations involving a Schedule C and EIC that should raise red flags. Again, this is not something that's common in the VITA TCE program. You don't see a lot of returns with a Schedule C and someone claiming EIC. The software is really good about asking clarifying questions as it relates to Schedule C and EIC in order to prevent a taxpayer from getting the credit and they should not have. Business expenses must be ordinary and necessary to be deductible. In the Schedule C instructions that you can find on irs.gov in your publication 17, in your 1040 instructions, it gives you examples of the type of business expenses and deductions that are considered ordinary and necessary. If the expenses that a taxpayer is advising you that they have do not look ordinary and necessary based on the type of business that they have, you are able to question that. And again, if anything feels suspicious to you or does not feel right, you do have the right to decline preparation of that tax return or get your site coordinator or assistant site coordinator involved so that it can be looked at, can be remedied, resolved, or that taxpayer needs to be referred to a paid preparer. In completing the Schedule C, the form it doesn't automatically populate. It's going to ask you, there's boxes that are there for expenses when you click into the Schedule C. And one of our scenarios do include a Schedule C, if I'm remembering correctly. And when you're entering the expenses, what you enter then populates the Schedule C for you, and then you're able to look at that Schedule C. A lot of taxpayers, even the ones with the Schedule C, don't come in with a lot of expenses, so there's not a lot for you to complete. But the software is pretty good about putting in, showing you where it is you need to put these expenses, and you need to question the taxpayer on what the expense is and what it was for to determine whether or not it was ordinary and should be used in the care of their business. If the taxpayer's Form W-2 has a statutory employee box checked, you want to follow the tax layer guidance for the Schedule C. It refers you to the link and learn topic for out of scope situations as it refers to a Schedule C. Again, the Schedule C is not a real big thing that you will see in the VITA TCE. While you will see some, there's not many that you will see or that you will have to complete as it relates to taxpayers. Business records should include a summary of business transactions and all supporting documents. You want to ensure that you review the publication 4012, which is tab D, income, for more information as it relates to that. And although some taxpayers may need to reconstruct their records to support the claim business income and expenses, that is fine. You just need to make sure that you make them aware that they need to keep those reconstructed records in the event that there is an audit. While you don't need detailed information, receipts, paperwork, if IRS does an audit, they will. Out of scope is any Schedule C with hobby income or not-for-profit activity, expenses over $50,000. If a taxpayer is running a business and they have return and allowances, or they have inventory, which is considered cost of goods sold. If they have employees and they have expenses for employees, if they use their home in the midst of their business, if they've experienced any type of casualty losses, if they have vehicle expenses reported as actual expenses, if they do contract labor, if they have any type of depreciation, if they had a vehicle rental or lease of more than 30 days, if they use any type of accounting method other than the cash method, if their Schedule C results in a net loss, that's out of scope. There's a line G on the Schedule C. If that is answered no, that's out of scope. It says credit card payments are not includable in income. And if they answer yes to the indicator that they need to file a Form 1099, then those are out of scope for the VITA TCE program. One of the things that the VITA or the TaxSlayer software does not do is it's not going to stop the return from being processed if something is out of scope. And so that's why it's so important for the interview process to be completed. So if a taxpayer came in and they have a Schedule C and they are doing the income and you are doing the income and then you go to the expenses and it results in a net loss, the software is not going to stop you from entering that return because it shows a net loss. Unless there's something new this year, the software isn't going to stop that return. And so you won't know that Schedule C actually shows a net loss until you look at that Schedule C or until it shows that it is a loss versus a profit. And so that's why it's important for that interview process to be completed. And even then, that interviewer may not be able to tell whether or not that Schedule C is going to result in a net loss. While business income or loss is generally beyond the scope of VITA TCE, in some cases you may help self-employed taxpayers who qualify to use limited Schedule C. This lesson covered where to get business income and expense information, that cash income must be reported. It advised that qualified Medicaid waiver payments are treated as difficulty of care payments and are excludable from gross income. It didn't go into reference I don't think there's any tax lesson that go deep into qualified Medicaid waiver payments. That's not something that's common with the VITA TCE program. This lesson told you how to determine what records to maintain, that there are certain situations involving Schedule C and EIC that should raise red flags, although it didn't tell you what those red flags were, and that record reconstruction may be required to support a taxpayer's claim on business income and expenses. Any questions as it relates to Schedule C or business income? Capital gain or loss. You should be able to determine the adjusted basis of capital assets, determine if the asset's holding period is long-term or short-term, calculate the taxable gain or deductible loss from the sale of capital assets, determine whether a home is a taxpayer's main home, or determine if the taxpayers meet the ownership and use test. Determine when the 5-year ownership use test period is suspended. Again, I have to be honest, a lot of the things that you will see in this training is not something that's common with the VITA TCE program. I think I saw a 1099-S for the sale of a home one time years ago. I haven't seen it again. Capital gain or loss is something that you may see. It's not as common. And so it is covered in one of our scenarios where we will go over on Wednesday to show you where it goes and how to input capital gain or loss, but it doesn't go over a 1099-S. The Schedule D and the Form 8949 are the forms that are used for reporting capital gains and losses. When you enter the information for a capital gain or loss, it automatically populates the information to the necessary schedules or forms. And so you don't have to go figuring out which form or schedule you will need. The cost basis as it relates to a capital gain or loss is the original purchase cost. There is a holding period, and that is the time between the date of purchase and the date of sale. And the sales price is the proceeds of sale of asset, the gross or net that is reported on the Form 1099-B. If there is no Form 1099-B, the taxpayer must provide this information to you. If the taxpayer is reporting capital gain or loss, if they are reporting the sale of an asset, whether it be a stock or a bond or whatever it is that they have, then they have all the necessary information for you. You'll never have to guess or you'll never have to question. They're going to come in with the information you need in order to report this gain or loss on their return. The basis of stock. The basis is usually the original purchase price of an asset. It is there is an adjusted basis, and all the information is on the form that the taxpayer is going to bring in for you. You won't have to guess. Again, if it's something that's missing from those forms, the taxpayer is going to tell you when I bought it, when I sold it, how much I sold it for, how much I bought it for, and so you won't have to guess on what that information is. But the adjusted basis is the price or cost plus commissions or fees paid at the time of the purchase. Again, it advises you that the taxpayer must provide that information for you. If the taxpayers received property as a gift or inheritance and do not know the basis, you want to refer them to a professional or paid tax preparer. There are holding periods as it relates to capital gain or losses. The short-term holding period is 1 year or less, and it is taxed at a regular income tax rate. The long term is more than 1 year, and it's taxed at a lower rate than the short term. Mutual fund shares are generally acquired at various times in various quantities at various prices. Figuring the basis can be difficult. It refers you to the publication 550 for information on how to report the sale or exchange of mutual fund shares. Blocks of stock may have differing holding periods and basis. Unless specified at the time of sale, blocks and shares are sold using the first in, first out method. And again, the forms, there is an example in one of our scenarios that you will see, and it shows you a short-term, long-term capital loss and gain. And so you'll get a chance to see what that looks like if you have not already looked at the scenarios for the advanced lesson. Brokers report information about sale of stock on the Form 1099-B. If there are entries in boxes 8 through 13 on that form, then they are out of scope for the VITA TCE program. Unless securities sold were non-covered securities, brokers must report the cost or other basis and whether a gain or loss is short-term or long-term. The tax layer Schedule D capital gain or loss screen determines short or long-term gain and calculates gain or loss, the tax liability, and capital loss carryover. Stock sales and other distributions may be reported by brokers on a 1099 consolidated statement or substitute 1099. The software does everything for you. There is no calculations that you have to do. There is no figuring out of where to what form that you need to pull, what schedule this needs to apply to. The software does all of that for you. As long as you're putting the information where it needs to go, it's going to pull the necessary schedules and forms that is needed for that return. The Form 8949 is used to report details of capital gain or loss transactions. The short-term transactions go on that form on page 1. Page 2 is used for long-term transactions. It again refers you to publication 4012 under the income tab D for adjustment to basis for more details. The Forms 8949 subtotals transfer because you can have more than one Form 8949, and so they will compile and transfer to the Schedule D as a whole. Again, as long as you are entering the data in the Schedule C capital gain or loss screen, it will automatically transfer to the Form 8940, 8949 and the Schedule D as it needs to apply. If data from source documents is entered properly, amounts will be reported in the appropriate places. And that's just not for the Form 1099B or the 1099 DIV. That's for any form that you are entering. So if it needs to populate a different form or a different schedule, as long as you are putting it in the respective place, then it's going to populate the form that is needed. Capital loss carryovers. The most loss that a taxpayer can take in a single year as a capital loss carryover is $3,000 or $1,500 for married filing separate. If a taxpayer has a capital loss carryover from a previous year or one that they're trying to bring over, then they should be able to tell you that. It should be listed on their 13614C. Unused losses can be carried over to later years and to gone. A previous year return is needed to figure the capital loss carryover. There is a worksheet in the Schedule D instructions. And if the loss is over the limit, the tax software reports the maximum allowable deduction. As I mentioned on Saturday, you don't have to figure out what any maximum is for any credit deduction or anything to that nature. The software automatically applies the maximum amount that's allowed to anything that you are entering. So all you have to do is to enter the amount, and the software is going to cap it at what that max is. Taxpayers may be able to exclude from their taxable income the gain from the sale of a main home. They can claim up to a maximum of $250,000 or up to a maximum of $250,000 for single head of household, married filing separate, or $500,000 for married filing jointly. Volunteers need to confirm the home sold was the taxpayer's main home and the taxpayer meets the ownership and use test. It refers you to the publication 523 for more information. Again, this is not something that is common that you will see. If it is something that you see and you're not certain of what it is you need to do with a 1099-S for a sale of a main home, you want to always refer to your site or assistant site coordinator for assistance or a more seasoned volunteer preparer who may have seen it and can help you through it. There are ownership and use tests that must be taken into consideration if a taxpayer has sold a home. During the 5-year period ended on the date of the sale, the taxpayer must have owned the home for at least 2 years, which is considered the ownership test. They must have lived in the home as their main home for at least 2 years, which is considered the use test. And in addition, during the 2-year period ended on the date of the sale, the taxpayer must not have claimed an exclusion on a gain from the sale of another home. Again, if a taxpayer is coming in and they have a 1099-S for the sale of a home, these are questions that needs to be asked. I can't remember if the software will ask these questions or not. And so again, if you see a 1099-S or any document that you're not certain of or sure of, you want to refer to your publication 4012 or a more seasoned volunteer preparer or your site or assistant site coordinator for assistance. Don't just automatically assume because they have a 1099-S, they qualify to claim the sale of their home. They need to, those questions for the ownership test and the use test needs to be asked and answered. Figuring the gain or loss on the sale of a home is based on the selling price, the amount realized, the basis, and the adjusted basis. There are worksheet examples of this in your publication 523. The loss on the sale of a personal residence is not deductible. The only thing that a taxpayer is able to claim is the gain on the sale of a home. So if they sold the home, there was proceeds left, then or a gain, then that they can claim that. But if there was a loss, it's not deductible. The gain must be reported when the amount is greater than the allowed exclusion and the home is not the taxpayer's main home. If the taxpayer received Form 1099-S for their gain or loss on the sale of a main home, it must be reported on Form 8949 and Schedule D. The 5-year ownership and use period may be suspended during any period of qualified official extended duty for a taxpayer who is a member of Uniformed Services or Foreign Service of the U.S., intelligence community employee, or an employee or volunteer of the Peace Corps. Qualified official extended duty if they serve at a duty station at least 50 miles from their main home, or live in government quarters under government order, or have been called to active duty for more than 90 days or indefinite period. Out of scope for this lesson is taxpayer who sold any assets other than stock, mutual funds, or personal residence. If they come in and advise you that they had any other type of asset that they sold, it's out of scope for VITA TCE. Taxpayers whose trade in options, futures, or other commodities. Taxpayers who answer yes to the digital asset as it relates to virtual currency on the Form 1040. If there's a determination of basis issues, if there are like-kind exchanges and worthless securities on the Form 1099, if the boxes on bartering are checked, if there's a reduced exclusion computation or determination in the sale of the home, married homeowners who do not meet all the requirements to claim the maximum exclusion on the sale of a home, if there are decreases to basis, including a deductible casualty loss and gain, a taxpayer postponed from the sale of a previous home before May 7th, 1997, and depreciation during the time the home was used for business purposes or as rental property. Taxpayers with non-qualified use issues or sale of a home used for business purposes or as rental property. None of the information that we are covering, going over, that I advised on Saturday, today, Wednesday, needs to be memorized. All of this information is available. As long as you know where to get the information, then you are able to complete what it is that you need to complete. Don't think that you have to memorize all this information, all this key information, which is why I advise for you to get a 4012 if you don't already have one, and take that 4012 with you when you are volunteering. That's going to be your easiest and quickest way to find an answer to most of the common questions that you are asked when you are at these VITA sites. In this lesson, you learn how to identify an asset's holding period, adjusted basis, the net short-term and long-term capital gains or losses, the taxable gain or deductible loss, and the amount of capital loss carryover. Taxpayers must use Form 8949 and Schedule D to report capital gains and losses. Completion of Form 8949 and Schedule D requires information from Form 1099-B and Form 1099-DIV or a 1099 consolidated statement, and from taxpayers' records. Information from a taxpayer's prior year return is needed to compute a loss carryover amount. The lesson also covered how to report the sale of a taxpayer's principal residence. To exclude the gain from sale of a home, the home sold was a taxpayer's main home, the place where the taxpayer lived most of the time. They must pass the ownership test, meaning that they owned the home for at least 2 years, and they must pass the use test, meaning they lived in the home as their main home for at least 2 years. The required 2 years of ownership or use need not be continuous. The taxpayer did not exclude gain in the 2 years before the current sale of the home, and the 5-year test period can be suspended for taxpayers serving on qualified official extended duty. Any questions or concerns as it relates to that lesson? All right. The 1099-R series or retirement income is a common income that you will see when preparing a return, especially depending on the site that you go to. A lot of sites cater to more senior taxpayers, and so the retirement income is one that you will commonly see. So at the end of this lesson, you should be able to identify how retirement income is reported to the taxpayer using Form 1099-R series, calculate the taxable portion of different types of retirement income, determine how to report retirement income on the tax return, and determine when an adjustment to withholding should be made. The Form 1099-R series, that could be a 1099 CSA, CSF, RRB, or 1099-R, are used to report retirement income. 1099-Rs are the most common that you will see. I think I may have seen a few RRB. I've never seen a CSA or a CSF, but a 1099-R is the most common that you will see, and that's a screenshot of what that form looks like. The forms indicate the amount received, the taxable portion, and the taxpayer's cost or their investment into the retirement plan. It refers you to your publication 4012 under Form 1099-R for more information. Retirement plans are funded by either before tax or after tax contributions. This funding status determines if the distribution from the retirement plan is taxable. If the taxpayer did not contribute to the retirement plan, all the distributions are fully taxable. If the taxpayer made all contributions to the plan with before tax dollars, the entire distribution is fully taxable. If the taxpayer made all contributions to a plan with after tax dollars, then the distributions would be partially taxable. The portion that represents earning is taxable since it has not been previously taxed. Again, this is not something that you will need to figure out whether or not it's taxable or non-taxable. A lot of the forms will have a taxable and non-taxable amount on it. If it's not listed, then there are ways for you to determine whether or not what part of that is not taxable. What is the difference between distributions from a Roth IRA and a traditional IRA? Roth IRA distributions are generally tax-free because the contributions were after tax, while traditional IRA distributions may be fully or partially taxable because the contributions may have been deductible or non-deductible. Additional taxes may apply to non-qualified distributions from a Roth IRA. Taxpayers who made non-qualified Roth IRA distributions should be referred to a professional tax preparer. Distributions from simple and SEP IRAs are in scope for VITA TCE because they are taxable and are generally reported on the return, just like taxable traditional IRA distributions. Distributions from simple IRAs in the first 2 years with a code of S can only be rolled over tax-free into other simple IRAs. Taxable simple IRA rollovers are out of scope for the VITA TCE program. Distribution codes on Form 1099-R have explanations. A lot of the times, those explanations will be on the back of that 1099-R. You can refer to your publication 4012 or your publication 17, or you can look in your 1040 instructions for explanations of what those distribution codes mean. But a lot of times, if a taxpayer hands you a Form 1099-R, you can flip it over and those distribution codes are on the back of that form. Distributions rolled directly into another qualified plan are not taxable, which is code G. Generally eligible rollover distributions paid to the taxpayer are not taxable if they are rolled over to another qualified plan or retirement account within 60 days. Roth account rollover is code H. When are pension or annuity payments fully taxable? Taxpayers did not pay any part of the cost of their employee pensions or annuities. Employers did not withhold part of the cost from the taxpayers' pay while they worked. And employees withheld part of the cost from the taxpayers before tax pay while they worked. Again, a lot of the forms, majority of the forms have what is taxable and what is not. And so that is not for you to figure out. If you need to figure out the taxable portion of pension or annuity, there are two ways in order for that to happen. That's the general rule, which is out of scope for the VITA TCE program, and the simplified method. When you get into tax layer, if the taxpayer provides you a form 1099-R and it does not have what amount of that distribution is taxable, you can use a simplified method. It's built into the software. All you have to do is to click the link inside of the software that'll take you to a worksheet for the simplified method. There is some questions that you'll have to ask the taxpayers in order for that to be completed. We do have an example of this as one of our scenarios for the advanced certification. Disability income from a retirement plan is taxed differently depending on the taxpayer's age. It's taxed as wages if it's before minimum retirement age, and it's taxed as pension if it's after the minimum retirement age. Some distributions that a taxpayer receive are subject to additional tax, and that's computed on the form 5329. Only part one of that form is within scope of the VITA TCE program. And so that when you're entering a 1099-R, it will ask you questions to determine whether or not, if that taxpayer is under the retirement age, then it's going to automatically calculate that penalty. But there are questions that you can answer or exceptions that you can input in order to determine whether or not a portion or all of that income is not subject to that additional tax. Once you do that, that form 5329 will automatically populate with the information needed to exclude whatever amount should not be taxed. This states when to adjust withholding. If after filing the return, the taxpayer owes a balance, you can have the conversation with the taxpayer on why there is a balance due and what it is that they need to do in order to avoid having a balance due in the future. You can discuss with the taxpayer how they can request withholding using the form W4P, form W4R, or the form W4V in order to have withholdings out of their retirement. If no withholding, the taxpayer may need to make quarterly estimated tax payments. It refers you to your publication 505, tax withholding and estimated tax. Another thing that I do if a taxpayer owes is I refer them to irs.gov for them to utilize the withholding calculator to determine whether or not they need to adjust their W-4 in any type of way. And so that is a conversation you can have with the taxpayer if the taxpayer asks why they owe. A lot of times the taxpayers, if they owe a balance, a lot of the taxpayers know why they owe. And so there's not a conversation you will have to have, but you do have some taxpayers that are generally surprised when the end of their return shows they owe a balance, and they are asking, why do I have the balance, or what can I do to ensure that I don't have this balance in the future? And so if you're able to have the discussion with them, you can. This lesson covered identifying, calculating, and reporting the taxable portion of retirement income, the types of retirement income and the forms used to report it, the requirements for taking minimum distributions, and when adjustments to withholding may be needed. Any questions or concerns on retirement income? Out of scope is the Form 8606, any non-deductible contributions made to a traditional IRA. Taxpayers subject to an additional tax due to excess IRA contributions. Roth IRA distributions that are taxable or partially taxable, and those with Form 1099-R, code J or T. If a 1099-R has code 589A, E, K, N as in Nancy, P as in Paul, R, and U. IRA rollovers that do not meet the tax-free requirements. Part of a distribution is a return of after-tax contributions. The general rule used to figure the taxable portion of pensions and or annuities. Form 1099-R with distribution code A and contributions to simple and SEP IRAs. The next lesson discusses Schedule K1s and rental. You should be able to identify Schedule K1 income items that are within the scope of the VITA TCE program and to determine how to report Schedule K1 income items and determine which types of rental income must be reported. A Schedule K1 reports taxpayers' share of income and other distributions, deductions, and credits from partnerships, S corporations, and some estates and trusts. Limited Schedule K1 income topics and reporting forms are in scope. If it's an interest income, a dividend income, qualified dividends income, if it's a net short-term capital gain and loss, a net long-term capital gain and loss, tax-exempt interest income, a royalty income that's reported on the Schedule E. That's only in scope if the source document is a Schedule K1 or Form 1099 miscellaneous Box 2 royalties with no associated expenses. Generally, income from renting a room or home to a tenant is reported on Form 1040 Schedule E. Property must have been rented at fair rental value. If not, the income and expenses are reported differently and it is out of scope. There are two methods of accounting: cash basis, which is the most common as it relates to rental income, and the accrual method, which is out of scope for the VITA TCE program. This is not something that's common with the VITA TCE program, although I have seen it or it has been done several times. It's not something that's common. The more common deductible rental expenses is mortgage interest, property taxes, property insurance, auto and travel expenses related to the production of the rental income. That's only if they're using the standard mileage rate, actual expenses out of scope, and property repairs. There's a difference when it comes to repairs and improvements. So if a taxpayer is doing repairs to keep the property in good operating condition and the costs are current year deductions, those are considered repairs. Those are what can be claimed on that Schedule E. If the taxpayer is doing anything to the property to add to the life or material value of the property or to prolong its life or adapt it to new uses, then that's considered improvement. And so improvements can't be taken. As long as it's a repair, they need to fix something to keep the property going, to keep it in good condition, then it's an expense. But if it's something that they just want to do to improve the property, then no. Depreciable property includes buildings, machinery, furniture, vehicles, improvements to the rental property. Land and land improvements are not depreciable. There are three factors or basic factors that determine the amount of the depreciation: the basis of the property, the recovery period for the property, and depreciation method used. There are some special allocations that are used to determine rental versus personal use. The personal use of a dwelling unit can limit the deductibility of rental expenses, such as the mortgage interest and property taxes. They are allocated separately on both Schedule A and E if there's a personal use. It refers you to the worksheet located in Publication 527 under Chapter 5 for more information. Rental loss, passive income versus active participation. Taxpayers who are not active participants may not deduct rental losses that exceed rental income. There are two restrictions on how much a loss from passive activity can offset other sources of income. There's an at-risk rule, which means the taxpayer can claim a loss only up to the amount for which they are personally at risk in the activity. And the passive activity rule, which is losses that exceed rental income that are not deductible. Again, it refers you to the publication 925 for more information. To report a rental loss, you would need the Form 8582. Form 8582 is generally not required if they are reporting a passive rental loss if the taxpayer has only one passive loss generated from a rental activity and an AGI of less than $100,000. If there is doubt on a rental loss, it advises you to refer the taxpayer to the IRS or a paid professional. Rental income, again, is not something that's common that you're going to see, especially when a taxpayer is reporting rental loss. And so, but if you have any questions as it relates to whether or not this is in scope or whether or not this is something that you can do, whether or not what information is needed, you want to always refer to your site coordinator or assistant site coordinator, especially if you can't find the information that you need in order to get your question answered. Any questions or concerns as it relates to Schedule K1 and rental income? Schedule K1 items, again, that are within scope is Schedule B, interest or dividend income. Schedule D, net short-term or net long-term capital gain and losses. Form 1040, tax exempt interest income. And Schedule E, if a taxpayer has royalty income. Out of scope, Schedule K1 items other than the 6 income items specifically mentioned in this lesson as within scope: royalty income with associated expenses, taxpayers who rent their property at less than fair rental value, rental related interest expenses other than mortgage interest, the actual expense method, if the taxpayer had a casualty loss, if they need to complete Form 8582 and completing Form 4562. If they answer yes to question A on Schedule E, indicating a Form 1099 filing requirement, and rental income and expenses for non-military families renting their personal residence. The next lesson goes into unemployment compensation. I think this is a relatively short lesson. It just tells you, or hopefully you'll be able to identify unemployment compensation and determine how to report unemployment compensation on the tax return. This is another comment that you may or may not see. We know that unemployment compensation was big back during the pandemic. It's not so much now, but it still may be common for you to see a 1099-G for unemployment compensation. It is reported on a Form 1099-G. So if a taxpayer advised you that they had or received unemployment compensation during any period of the tax year, then they do need that Form 1099-G. It is taxable in most cases, and it is not considered earned income for calculating the EIC. The amount of unemployment received is shown in box 1 of that Form 1099-G. The amount of the withholding is shown in box 4. If the taxpayer has more than one Form 1099-G, you're going to enter each form in the software, and the software is going to compile those forms and consolidate that total on the line of where it needs to go on that 1040. Any questions or concerns as it relates to unemployment income? Social Security benefits is another common income that you'll see. And so we want to be able to determine the taxable portion of Social Security and railroad retirement benefits, and the most advantageous method of reporting lump sum Social Security benefits. Again, you don't have to figure out the taxable portion of the Social Security benefits. All you have to do is to enter the information into the software. The software does all the calculation for you. We know that Social Security benefits are old age, survivor, and disability insurance, or OASDI. It is a monthly retirement and is reported to taxpayers on the Form SSA 1099. Railroad retirement benefits are RRBs. There are two different tiers as it relates to railroad retirement benefits. Tier 1 is Social Security equivalent benefits, and Tier 2 is treated as a qualified employee plan. The forms look similar, and so you need to ensure that you are entering the correct information on the correct form. If the taxpayer brings you a 1099 or SSA 1099 or an RRB. So you need to ensure what form you have and ensure that you're entering the information in the right place. The publication 4012 SSA 1099 distribution shows how to enter that data in TaxSlayer. It's pretty simple when you get into the software. It acts as if it's under 1099 and it'll tell you Social Security benefits. And so it's pretty simple on where to enter the information in. You want to ensure with every form that you are entering information from that you are picking up the right boxes and the right amount as it applies to those boxes. The taxable amount, if any, depends on the filing status and any other reportable income the taxpayer may have, whether the benefits were the taxpayer's only source of income. That Social Security benefits for most taxpayers only become taxable if they have additional income over a certain amount. And so you just need to enter all that information into the software, and it will figure out what is the taxable portion of the taxpayer's Social Security. If taxpayers receive lump sum benefit payments, it's going to be listed on that form 1099 SSA. There are two options for reporting lump sum benefit payments. Report the entire payment in the year was received, or treat the benefits as received in the earlier year or years if it lowers the taxable portion of the benefits. The taxpayer can choose which option they want. But if the taxpayer chooses the second option, only the current year income will be adjusted. We will not file amended returns for earlier years. This is a screenshot of what a SSA 1099 looks like. And so we just want to ensure that we are picking up any amount that's listed in any box on that form. Any questions regarding Social Security benefits? Again, if the only source of income for that taxpayer is Social Security or railroad retirement benefits, then those benefits are generally not taxable. If there was other income, the software will again complete the worksheet to determine what is the taxable portion of those benefits. There's some other income that are not listed on the Form 1040 individually. That income is calculated on the Schedule 1 and compiled in a consolidated amount and transferred over to the 1040. And so this lesson talks about other income that a taxpayer can potentially have. And so this lesson will talk to you about other types of income and how to report them, determine the requirements for the cancellation of debt on non-business credit card debt, determine when canceled credit card debt is included in gross income on Form 1040, Schedule 1, how to properly report income earned from worldwide sources, and who is eligible for the foreign earned income exclusion, and how to calculate that excludable amount using Form 2555. Some examples of other income, and on the screen, it shows you a screenshot of the Income Quick Reference Guide that is available in your publication 4012 under Table A. I think we talked about this at one point of examples of taxable income. But some examples of other income that you may or may not see will be prizes and awards, gambling winnings, and these winnings can include lotteries and raffles, cash for keys, which is not something I've ever seen or something that this lesson goes into, jury duty pay, Alaska Permanent Fund dividends, non-business credit card debt cancellation. It refers you to the publication 4491 for details on types of income, such as health savings account distributions, qualified Medicaid waiver, um, account is a 529 plan, or if you want more information as it relates to gambling winnings, cash for keys, and penal income. Ten 1099-C is a form the taxpayer will receive if a company, an agency, an individual has canceled any type of debt the taxpayer may have had. The most common that you'll see is credit card debt, but it can be for any type of debt that's canceled. The taxpayer will receive a 1099-C. But if a taxpayer receives Form 1099-C for canceled credit card debt and was solvent, all the canceled debt would be included on Form 1040 other income line. To 1099-C is not something that's common in the VITA TCE program. You don't have to determine whether or not the taxpayer qualifies to include the 1099-C on their return. If they bring it, add it to the return, the software will do the calculations and figuring of that 1099-C. Worldwide income is income earned outside the U.S. that's subject to the same taxes and filing requirement as U.S. income. The amounts are reported on a U.S. return and must be converted to U.S. dollars. The exchange rate that's used is the rate that was in effect when the income was received. The average annual exchange rate can be used if the foreign income was received evenly throughout the year and the foreign exchange rate was relatively stable during the year. This is not something I've ever seen. I don't think that you may see it. If you are at a site that deals with foreign students, foreign nationals, things like that, then you may come across this. But if you're at a general VITA TCE site, worldwide income is not something that is common or that you may see. Foreign earned income is another that is not something that's common. That unless you are at one of those sites that focuses on foreign students or international students, things of that, or international taxpayers or foreign taxpayers. But the foreign earned income exclusion allows qualified taxpayers to voluntarily exclude foreign earnings from taxable income. That amount is indexed to inflation and it's updated yearly. It does not apply to members of armed forces or U.S. government employees. The taxpayers cannot claim the earned income credit or foreign tax credit if using this exclusion. It refers you to Chapter 4 of Publication 54, and this exclusion is claimed using Form 2555. To be eligible to claim the foreign earned income exclusion, the taxpayer must demonstrate that his or her home or tax home is in a foreign country. They must meet a period of stay requirement and have income that qualifies as foreign earned income. Married couples, the requirements must be met separately for each person. Taxpayers whose regular place of abode is in the U.S. cannot be considered to have a foreign tax home and would not qualify for the exclusion. The period of stay, the bona fide residence test, the taxpayers must have set up permanent quarters in a foreign country for an entire uninterrupted tax year. The physical presence test means that the taxpayer must be physically present in a foreign country 330 full days in 12 consecutive months. They must have qualifying income that must be earned, income for services. That can include salaries, wages, commissions, professional fees, or self-employment income. The income that would not qualify are dividends, interest, capital gains, alimony, Social Security benefits, pensions, and annuities. Other income, again, for the foreign earned income is reported on the Form 2555 using TaxSlayer. And then it's transferred to the 1040 other income line. Out of scope is distributions from an ABLE account in which the funds were not used for qualified disability expenses, distributions from educational savings accounts in which the funds were not used for qualified education expenses, or distributions with more than the amount of the qualified expenses, or taxpayers who are insolvent and had debt canceled. Any questions or concerns as it relates to other income? Adjustments to income. The most common adjustments to income are self-employment income and tax, self-employment health insurance, if they had penalties on early withdrawals of savings, alimony, contributions to an IRA or HSA, student loan interest, and jury duty income repaid to the employer. The total income minus adjustments equal the taxpayer's adjusted gross income. Student loan interest is one that you most commonly see. There is a cap on the amount of student loan interest that deduction or adjustment that a taxpayer can take. You won't need to remember what that cap is. The software is going to automatically take that cap or maximum for you. It refers you to the publication 4012, tab E, under adjustments. Educator expenses is one that has a cap. Again, you won't have to remember what this cap is. If a teacher comes in and advises you that I am a K through 12 teacher, I work a minimum of 900 hours, and I had expenses of $900 that I took during or that I spent during the year. You can put in the full $900 under educator expenses, and the software is going to cap it at that $300. So you don't have to go to your 4012, your publication 17, or anything like that, trying to remember what this cap is. The software is going to automatically take it. Teachers know that they're able to take this adjustment. And so if they're coming in to get their return done, they know to automatically or to advise you that they are a teacher and that they have these expenses and what these expenses for, because they know what the requirements are. So you won't have to do a lot of probing or prodding to try to figure out what these expenses were for to see if they qualify, because majority of the teachers know what they can and cannot claim. They can use expenses for books, supplies, equipment, or other materials used in the classroom. They can't use it for expenses as it relates to homeschooling, non-athletic supplies for physical education, or supplies for health courses. The self-employment tax. A portion of self-employment tax can be subtracted from the total income. It's automatically calculated when you complete a Schedule C or business income. The self-employment tax is automatically calculated. This is not something that you'll need to do. You won't have to figure out what form to use. That self-employment tax is automatically calculated based on the interest that you input for business income or Schedule C. On the Form 1099 INT, there is a box for early withdrawal penalty. And so you want to make sure that you're picking up any entries that's on any form, any box on any form that you receive. That penalty amount is entered on the interest statement in TaxSlayer. So when you're going through, the taxpayer gives you an interest statement from their bank or credit card statement or wherever it's from. If there's an early withdrawal penalty, it's going to be listed on that form, and you're going to enter it while you're entering that interest statement. We talked about alimony during the income portion, but alimony payments subtracted from income by the payer, reported as income by the recipient. Again, alimony is not something that is common or that you will see. I don't think I've ever seen alimony since I've been doing VITA, but it advises you to not confuse alimony payments with child support payments, which are not deductible. IRA contributions. Only contributions to traditional IRAs are deductible. Taxpayers may contribute and deduct up to $7,000, $8,000 if they're over 50. Contributions cannot be more than taxpayers' yearly compensation. Deductions can be phased out depending on the income or the modified adjusted gross income of the taxpayer, their filing status, and the availability of employer-provided retirement plan. There's an IRA deduction worksheet. Again, you doing calculations is not something that has to be done. The software does everything for you. Health savings accounts, or HSA, these are becoming more and more relevant or prevalent. And so you may see these. If a taxpayer has an HSA, the taxpayer or their spouse's Form W-2 will contain code W in box 12 for employee contributions. If the taxpayer or spouse took any type of distributions from their HSA, then they should have a form 1099 SA with the box showing distributions from their HSA. And so taxpayers who have taken these type of distributions from those accounts already know to have those forms available. Student loan interest is the most common one that you will see. Generally, the smaller $2,500 or the interest paid that year on a qualified student loan is phased out or eliminated based on the taxpayer filing status or modified adjusted gross income. It's reported to the taxpayer on the Form 1098E, Box 1. It refers you to publication 4012 or the publication 970 for more information as it relates to student loan interest. Any questions or concerns as it relates to adjustments to income? It lists jury duty pay turned over to the taxpayer's employer. While it did not go into any information as it relates to that, if you have a taxpayer that has any type of jury duty pay, there is a section for jury duty pay under adjustments. And so if they have any documents as it relates to that, then you will just enter that jury duty pay in that section. Out of scope is self-employed health insurance deduction with premium tax credit calculations, self-employed SEP, simple and qualified plans, certain business expenses of performing artists, and domestic production activities deductions, or the Form 8606 non-deductible IRAs. Any questions or concerns on anything that we've covered?
On that jury duty pay, is that what they receive from the court, or their employer is actually paying them for jury duty time?
No, so it says pay that was turned over to the employer. And so if you receive sometimes the job will pay you for jury duty pay. And so and they may require you to turn the check in that you get from jury duty. And so if the employee requires you to turn that payment over to them, then they should give you some sort of document showing that you turned that jury duty pay over to them.
Okay.
It's not common for a lot of employers for them to pay you for jury duty and then for you to turn that money over to them that you receive. And so it's not something that you would commonly see. All right. So it is 8:51. Is there any questions or concerns about anything that we've covered on this evening, or anything that was covered on Saturday? All right. So there are a few more slides that we will need to go over on Wednesday. And so that should not take that much time for us to run through those slides it goes into the credit portion of it. And so, someone, is there a power? So I can send you the PowerPoints that I'm using, or if you go to Link and Learn, those presentations are listed on the Link and Learn landing page.
The PowerPoint is on the Link and Learn.
Yes. Let's
I got a
see.
question.
Mm-hmm.
Do you know if it's a list of sites, of vital sites that's in Memphis? Because we looked it up today and we couldn't find none that was in Memphis. The
Where
only
did you
ones we
look?
saw that was in Arkansas and in South Haven and Olive Branch.
Where did you
And
look?
on the IRS website.
Let's see. So I know United Way normally has a list of their sites. A lot of the, I may venture to say, majority of the sites here are probably covered under United Way. Um, and
Yeah.
so they normally have a listing of the sites,
Okay, so
especially the sites that they cover
we need to look at the United Way because when we looked at it, we used the locator tool, and that was
on
the only one.
irs.gov.
Yes, ma'am.
And I don't think that tool has been completely updated.
Okay.
We're still in the process of getting sites open, things like that from a spec standpoint. And so until those sites are completely open, then that tool doesn't show them as open. And
Okay.
so I will venture to say that that site may be completely or more updated by the end of the month. But as far as sites here, I would go on United Way or reach out to United Way to get a listing of their sites here in the city. And so I don't know. They used to have sites here in the city, Mississippi and Arkansas, and that still may be. And so you can choose where you are wanting to volunteer.
Okay.
And we do the IRS site locator tool that'll be updated right before we start the season. We're working on getting that updated now. If you go to our website at uwmidsouth.org slash free dash tax dash prep, you can see all of our tax sites, and there's a link there saying you can click here for a site schedule. It's still showing the 2025 one, but we're going to get that updated to show 2026 sites here in the next couple of weeks before we get started. It'll be the same location, so we'll just update it for the schedules for this year. But you can see a list of our sites on the United Way website right now.
Okay. Thank you.
You're welcome.
So I put the link for linklearncertification.com in the box. And so if you go to that landing page at the bottom, there's the presentations. And so the presentations are the same presentations that I'm using. I consolidated them because they come up individually. And so I just consolidated them for my presentation, took out what I didn't think was necessary to get us through. And so on Wednesday, there's a few more that we'll need to cover as it relates to credits and things of that nature. And then we can hop into the certification portion of it. And so what I would ask that you all do before Wednesday is to look at your form 6744, which is where you will get your test questions for the certification. The first six questions on the form on the advanced certification, I think it's the first six scenarios don't require you to use the practice lab. And so go through, look through that information and see if you can answer some of those questions yourself. And then what we'll do once we get into the certification part of it, for those of you who have not created an account on Link and Learn and Practice Lab, we'll do that. That's another thing that you can go ahead and do if you have not done that. You will need an email and password for both. You can use the same email, but you can't use the same password for Lincoln Learn and the practice lab. The requirements are different. And so if you've been in Lincoln Learn or Practice Lab before, you can use the same username and password. If you've never been in it, then you will need to create an account. If you need any assistance, you can reach out to me. I'll put my email address in the chat. So you can reach out to me by email if you need any assistance before Wednesday and getting any of that set up. For those of you at work, you can ping me on Teams or whatever that looks like if you need any type of assistance getting any of that set up. And so Monday we'll hop right into finishing those PowerPoints, and so that we can get into the certification as quick as possible so that we can get as far through that as we can. All right.
One last thing I just want to share. So with Lincoln Learn, we already mentioned you get 2 attempts at each test. But if you do not pass after those 2 attempts, then it'll essentially lock you out of that account. And unfortunately, I don't have any access within Lincoln Learn to unlock that. The only way to take it a third time is to create a new account with a new email. So, we've already gone over the standards of conduct exam and the intake interview quality review exam. So if you want to take those and use the notes from Saturday, by all means, go ahead. But if you have any reservations about the advanced law test, that's the one we'll be going over Wednesday. So if you already tried it and you didn't succeed in that first attempt, then I would say maybe hold off until after we go over it together on Wednesday. Just because, like I said, if you try it for a second time and you don't get it, then you'll have to recreate your Lincoln Learn using a new email and re-enter all your stuff from your previous exams and all your personal information. And it's just tedious. So if you feel comfortable and you want to go ahead and do it, you're welcome to. I'm not saying you can't, but just know that we're going to be going over all that Wednesday. So if you have any reservations at all, feel free to just wait until we go over it together on Wednesday, just because it can be a hassle to have to make a new Lincoln Learn account.
All right. And if you are retaking any of the certifications, the questions may be similar, but there are new questions, and so you won't get the same questions that you got the first time, or you may get them, but they're going to be reworded and be in a different order. And so if you've taken any of the certifications and did not pass, and you need to retake them, reach out to me to get assistance before you retake it, especially if there's something that you don't understand. Or if it's the advanced certification, wait until Wednesday. We're going to get as far through the certification as we possibly can, so that we can get as many of the questions for the certification answered as possible. All right. If there are no other questions, concerns, or matters of the heart, I give you your time back. I hope that you enjoy your evening, and I look forward to meeting with you all again on Wednesday.
Thank y'all so much.
Good night.
Good night.